So it's going to make a huge difference, especially in a market where smaller banks will have trouble raising capital. Uncertainty. I was talking to one of you, and that's one of the biggest things. Even though John's read the bill, even though we've read executive summaries, even though we've been to Washington and talked to Congress and talked to people on the ground, the devil's in the details. And what they intend when they pass a bill isn't always what comes out when it goes through the regulatory process. Regulators have rulemaking authority, and while it may be the intent to, for example, limit problems on the consumer side when they get a mortgage, once the rule comes out, it makes it difficult for anyone to get a mortgage or understand even what they're doing. How many in this room have tried to refi anything or get a home equity loan or anything in the last 6 months? Or heard of anybody that's done that? It is amazing. I had a customer, owned his house free and clear, wanted to take advantage of some opportunities in the marketplace, and it took about 6 weeks for us to close the deal because some new rules had been put in place and the title companies were completely aware of all the changes, and it seems to be there's a right of rescission on top of another right of rescission on top of yet another one, and it was about a 30-day process, and it is making us crazy, as you too, I'm sure, are aware. So, as we said, more expensive, less availability. Yippee. I don't make money unless I make loans, and all the bankers in the room will agree. So, why is CRE out of favor with Washington? Well, housing is a sacred cow. We used to talk about sacred cows all the time, not giving something up that really had passed its time. And affordable housing, housing for all, low down payments, that is a sacred cow that will not, even though the system didn't work, there doesn't seem to be a lot of impetus or political capital in emphasizing a problem with housing. Same with small business. Small businesses create lots of new jobs. That's the place to be. You don't want to go against small business. What's left? Well, commercial real estate. I think to Congress, it's a different world in that bubble once you get inside the Beltway. I don't think they understand that commercial real estate is it's a thing, I guess, but it involves people too. It involves you and me and John. It involves our livelihood, our families. Our small business customers have to have a place to manufacture whatever it is or have offices. So they're looking at it as if, well, this is a less political thing to be involved in. It's not going to hurt as many people as jumping on the housing or small business bandwagon. And that's just my opinion, so. And also we've been in a protracted recession, and that always starts affecting eventually, even in good markets like we're in, some crumbling in commercial real estate. People can't afford to pay their rents. They give you a hard time if you own a building. They want you to lower the rent. They want you to do everything, give them everything free for a long time. And so that hurts the economy at large, and it's just cyclical and builds up on one another. So where do we get the rules? Technically, you think we get them from Congress, but as I said, they really come from the regulatory agencies. The Office of the Comptroller of the Currency, who monitors national banks, and by national, it's the charter that you've chosen. It doesn't mean you're the biggest bank, because I'm a national bank. It just means that's the charter you chose to go with. The state, in combination with the FDIC, monitors the state banks, and then you have the Federal Reserve, which comes in and does examinations, sometimes on state banks, sometimes on just some specialized banks that don't have any of the other two. So it's an interesting concept. They started maybe, 5 years or so ago of doing interagency guidance, which is the CRE guidance that John was alluding to earlier, as to how much percentage of your capital you could have in certain concentrations and how much LTV you could do and what exceptions were to the rules. So those interagency guidelines are quickly becoming, and this is anecdotal, but I've heard it from the agency heads, are going to soon become the rules. And uncertainty is the killer. So when we know the rules, we're all creative and smart people. We were here in the 80s. We knew how to get out of it. Once we get the rules down, we'll get on with making business happen. All right, what is the new normal? I saw that in your flyer. Well, there's going to be more equity required. There's not going to be interest reserves rolled into loans. They're really hammering on that on the bank level. We're going to have a lot more strict adherence to LTV guidelines. The use of risk mitigators is going to be more, I think, on the part of banks, because that allows us, for example, if I were to do, I can't see where you are, but if I were to do a USDA loan in a rural area for a building, for example, and it's a $5 million project and I have an 80% guarantee, full faith and credit of the government, I only have to count $1 million toward that number that counts as my percentage of capital. So I can leverage my capital by using risk mitigating programs, be they SBA, USDA, and yes, they inspect meat, but they have rural business initiatives for builders, for nonprofits, for any kind of thing that will bring facilities and jobs to rural America. And rural means 50,000 or less. I actually did my first one in the Woodlands, and that was back 2 censuses ago. Censi, whatever. You know what I'm talking about. And we have Harry Leach here from the Capital Certified Development Corporation, which does 504 lending, which is strictly for commercial real estate, and I'm sure he'd be happy to come back and do something for you on that. So I came up with 5 rules of the road for going forward. It's all about cash flow. You're going to have to prove your cash flow. You're going to make sure that the investors you get to back a project don't just have high net worth statements, but they can prove that they have the cash flow to service the debt. And as I said, you're probably not going to see for a while interest reserves rolled into a loan. They will expect you to have that up front. So have good projections, realistic projections, expect them to be. You hear a lot about stress testing. That's one of the things the regulators make us do. We take your projections, we say what happens if 20% of this doesn't happen, what happens if 50% doesn't happen, where's the break-even point? And we're doing it on each and every project, each and every loan, and the entire portfolio. Real equity, as I said, is going to be required. And what's going to be interesting is loan-to-value ratios that we see are going to be even stricter than they are before. Here is the actual guidance out of the OCC handbook. You've heard it before. These are the actual guidance, if you will, for loan-to-value. Banks are allowed to loan more than that, but then they have to put it on an exception report, which is reported to the board of directors and to your regulatory agencies, your prudential regulator. So you can see that in the old days, we looked at those as guidance, as they said they were. And now they're going to become more hard and fast. And that's what I'm talking about on the equity. A little known rule that has been in place for apparently 10 or 15 years, but none of us, when I say us, bankers, were really holding to, do a lot of single-family residential construction, must be 25% down on the land portion. Let's say you're building a $500,000 house, the land costs $100,000, you will be required to at least have 25% in that, even if the appraisal is $1,000,000%, you know, over that. Even if it's $1 million house, they'll expect the builder to at least have $25,000 cash in that project. It's another, and they don't like it if you waive that rule. Appraisals. Well, I'm in the room that could tell me about this. You know they're gonna come in lower